Here are the main discussion points: the complexities and risk of holding crypto assets on behalf of the clients. The panel explored the complexities and risk involved when companies hold crypto assets for their clients. Now, this isn't as simple as holding traditional stocks or bonds. Crypto assets come with unique technical and security challenges. Think about issues like private key management, hacking risk, and the potential for irreversible transactions. The panelists emphasized that safeguarding clients' assets in this space requires robust security protocols and constant vigilance. Also, safeguarding clients' crypto assets is far more complex and risky than holding traditional financial assets because of the unique way cryptocurrencies are secured and managed. Here is why. Private key management is critical and risky. In crypto, access and control over assets are determined entirely by private keys. If a private key is lost, stolen, or compromised in any way, the assets it controls can be irretrievable, lost, or stolen. There is no central authority to reverse transactions or recover funds. This is fundamentally different from traditional finance, where banks and custodians can often restore access or reverse fraudulent transfers. Private keys must be generated securely, stored safely, ideally offline, and never exposed to unauthorized parties. Weak key generation, improper storage, or reuse of keys can all lead to vulnerabilities. If keys are not rotated or are used incorrectly, they become easier targets for attackers. Recent incidents show that private keys compromises have resulted in hundreds of millions of dollars in losses, with no recourse for recovery. For example, in Q1 2024, nearly half of all on-chain security losses were due to private key breaches. Once a crypto transaction is executed, it is irreversible. There is no way to cancel it or undo it, unlike with traditional bank transactions. The irreversible nature of blockchain transactions means that any mistake or malicious action, such as unauthorized access to a private key, leads to permanent loss of assets. This places enormous responsibility on custodians to implement robust security protocols and constant monitoring. Auditors and regulators require proof that effective controls are in place for the entire life cycle of private keys, from generation to storage to use. Any lapse in these controls can result in catastrophic loss for clients and custodians alike. In summary, the complexities and risk of holding crypto assets for clients stem from the absolute importance of private key security, the technical sophistication required to manage them, and the irreversible consequences of any error or breach. That's why the panel emphasized the need for robust, multi-layered security and constant vigilance in crypto custody. Next, the discussion moved to whether the existing SEC's custody rules, those under the Exchange Act, the Advisors Act, or the Investment Company Act, are actually fit for the purpose when it comes to crypto. The big question here is, can all rules designed for traditional assets really protect investors in the fast-evolving world of digital assets? Some experts argue that we need updated regulations that reflect the unique nature of crypto, while others believe the current framework can be adapted with careful guidance. The debate over whether current SEC custody rules are adequate for crypto assets centers on the fact that these rules were designed for traditional financial assets, not the unique features and risk for digital assets like cryptocurrencies. Different nature of crypto assets, cryptocurrency are fundamentally different from traditional assets such as stock or bonds. They are not based in institutional trust and rely on cryptographic keys for ownership and transfer. This creates a unique risk such as loss from hacking, programming errors, or private key mismanagement that traditional rules did not anticipate. The current SEC Custody Rule 206.4 2 requires investment advisors to hold client assets with a qualified custodian, such as a bank or broker-dealer. However, proving exclusive control over crypto assets is much more difficult than with traditional assets. For example, the transfer of crypto assets often requires the custodian to generate and maintain private keys, and any lapse in this process can result in loss or theft. While specialized custodians for crypto are emerging, there are still few industry standards, and many custodians lack the experience and infrastructure to handle the particular risk of digital assets. If the SEC applies the traditional custody rule mechanically, many crypto fund managers could unintentionally violate the rules simply because the infrastructure does not yet exist to fully comply. The SEC proposed safeguarding rule will require all client assets, including crypto, to be held with a qualified custodian. However, this approach may not fit all types of crypto assets, especially for those that are not clearly securities or are issued on public, permissionless blockchains. This broad application could create compliance burdens to uncertainty for advisors, as well as questions about the SEC's jurisdictions over some digital assets. Some experts argue that the unique risk and technical realities of crypto custody require updated regulations that specifically address these challenges. Others believe that with careful guidance and adaptation, the current framework can be made to work, but acknowledge that doing so will require significant clarification and possibly new exceptions or procedures. In summary, the adequacy of current SEC custody rules for crypto assets is questioned because these rules were not designed for the technical, operational, and legal complexities of digital assets. This has led to calls for either updated regulations tailored to crypto or significant adaptation of existing rules to ensure investor protection without stifling innovation. Another hot topic was the effectiveness of the so-called special purpose broker-dealer regime. This is a relatively new approach the SEC has introduced, specifically for firms dealing with digital assets. The panel debated whether this regime is enough or if we need an entirely new regulatory framework to address the specific risk and operational realities of crypto custody. The consensus seemed to be that while it's a step in the right direction, more work needs to be done to ensure clarity and safety. Now let's talk about the special purpose broker-dealer, the SPBD. The SPBD regime was introduced by the SEC as a way to allow broker-dealers to custody and transact in digital asset securities under specific, stringent conditions. While this was seen as a positive step toward regulated crypto custody, the panel and industry experts at the forum agreed that this is not a complete solution and more work is needed to ensure clarity and safety. Here's why. The SPBD regime only applies to digital asset securities, not all types of crypto assets. SPBD are restricted from dealing in traditional securities, except for limited purposes, and face strict compliance, disclosure, and operational oversight requirements. These narrow boundaries mean the regime does not address the full spectrum of crypto assets or the broader need of the market. The SPBD framework is still new and largely untested. Regulators, including the Securities and Exchange Commission, the SEC, and the Financial Industry Regulatory Authority, the FINRA, have acknowledged they lack practical experience with how these rules work in real-world operations. The SEC current approach is to observe and learn from early SPBDs with a 5-year window for non-action relief, after which the framework may be revised or replaced. But the operational and security challenges remain. SPBDs must demonstrate possession or control of digital asset securities, a requirement that is as straightforward for traditional assets but technically complex for crypto. The mechanism for securing, transferring, and auditing crypto assets are fundamentally different, and existing regulations do not fully account for these differences. Many in the industry and on the panel argue that a more comprehensive regulatory framework is needed, one that covers both security and non-security crypto assets, provides clearer guidance for operational best practices, and adapts to technological innovations. Expanding the regime or creating new frameworks will help address gaps, reduce uncertainty, and better protect investors. The current SPBD regime is temporary, with its no-action relief set to expire in 2026. There is uncertainty about what will replace it, whether the SEC will extend, revise, or let it lapse, and how future rules will impact the industry. In summary, while the SPBD regime is a step in the right direction for regulated crypto custody, its limited scope, operational challenges, and temporary nature mean that additional regulatory clarity and broader frameworks are needed to ensure both innovation and investor protection in the evolving crypto market. The panel also shared industry perspective on the operational, legal, and technological hurdles facing crypto custody providers. For example, how do companies ensure they are complying with both US and international laws? What about the technical side, like integrating with blockchain networks or managing the risk of smart contract bugs? These are real, everyday challenges that require specialized knowledge and constant adaptation. Industry perspective highlights significant operational, legal, and technological challenges in crypto custody because the nature of the digital assets and their underlying technologies is fundamentally different from traditional finance, requiring constant adaptation and specialized expertise. Crypto custody providers must balance the need for robust security, like cold storage, which is slow but safe, with the demand for quick, efficient transactions, which often require online hot wallets but increase hacking risk. Advanced technologies such as multi-party computation, MPC, and hardware isolation are helping. But implementing and maintaining these solutions is complex and costly. Providers must ensure clients have uninterrupted access to their assets, even during disruptions. This means building resilient systems, setting risk metrics, and planning for scenarios where they might need to quickly transfer assets to another provider if the custodian fails. Custody solutions often need to integrate with both blockchain networks and legacy financial systems for accounting, reporting, and compliance. Achieving seamless interoperability between these systems can be technically challenging and introduces additional risk. Crypto custody providers must comply with a patchwork of US and international regulations which can differ significantly by jurisdiction. This includes anti-money laundering, know your customer requirements, and varying definition of what constitutes a security or a commodity. The lack of clear regulatory definitions for many crypto assets makes it difficult for custodians to know which rules apply. For example, the SEC custody rules are not always easily mapped to digital assets, creating compliance risk and uncertainty for both custodians and their clients. Properly separating clients' assets from operational funds is critical for regulatory compliance and to prevent the kind of failures seen in high-profile exchange collapses like FTX. These require technical and procedural safeguards, regular audits, and transparent reporting. Custodians must securely connect with various blockchain networks, manage private keys, and handle smart contract interactions. Each blockchain may have different protocols and security requirements, increasing operational complexity. Bugs or vulnerabilities in smart contracts can lead to loss of assets or unauthorized transfers. Custodians must continuously audit and monitor smart contracts to mitigate these risks. As client demand grows and technology evolves, custodians must scale their platforms and adapt to new technologies of digital assets, which requires ongoing investment in technology and expertise. In summary, crypto custody is much more than simply holding digital assets. Providers face a constantly shifting landscape of technical, operational, and legal risks. These challenges require specialized knowledge, advanced security infrastructure, and the ability to adapt rapidly to new threats and regulatory changes, making crypto custody a unique demanding field compared to traditional assets custody. So finally, and perhaps most importantly, the panelists agreed on the urgent need for clear rules of the road. Both investors and industry players are calling for straightforward, transparent regulations that protect consumers without stifling innovation. The idea is to strike a balance, give innovators room to grow, but make sure investors are safe from fraud and abuse. Clear rules of the road are urgently needed in the crypto industry because both investors and businesses face significant risk and uncertainty without them. Here's why. The crypto market is vulnerable to fraud, market manipulation, and scams, as seen in high-profile cases like rug pulls and exchange collapses. Clear regulations act as safeguards, helping to prevent illicit activities such as money laundering and terrorism financing, and ensuring that investors are protected from abuses and catastrophic losses. When regulations are transparent and straightforward, investors feel more confident participating in the market. This increased trust attracts more capital and encourages broader adoption, which in turn drives innovation and market development. Overly restrictive or ambiguous regulation can stifle technological progress and deter new entrants. By providing clear, balanced rules, regulators can create an environment where entrepreneurs and established firms alike can innovate without fear of sudden enforcement actions or unclear compliance requirements. Ambiguity in existing rules, such as whether certain crypto custodians qualify as qualified custodians under SEC rules, create confusion for investment advisors, custodians, and investors. This uncertainty can slow down institutional adoption and limit the growth of legitimate crypto businesses. The global, rapidly evolving nature of crypto means that risk and opportunities can change quickly. Flexible, well-defined regulations help ensure that the market can adapt to new technologies and threats while still maintaining investor protection. In summary, clear rules of the road are essential to protect investors, boost market confidence, support innovation, and provide the legal certainty needed for the crypto industry to mature and thrive. If you want to dig deeper into these topics, I've included all the official SEC resources and links in this video description below. This way, you can see for yourself how seriously we take bringing you accurate, up-to-date information. As always, if you have any questions or want to share your thoughts on crypto regulation, drop a comment below. I love hearing from you. Thanks for watching, and I'll see you in the next video.